Hello again, everyone. I'm David Russell, Professor of Insurance and Finance at Cal State Northridge. As you know, insurance availability in the U.S. is under pressure. This is especially true here in California and other states like Florida. Today, we'll focus largely on California and the homeowners market, with some opportunity to speak about other lines or other states. I'm pleased to introduce our panelists for today's discussion. Our first panelist is Ben Christopher. He covers housing policy and has previously covered California politics and elections for Cal Matters. Based out of the San Francisco Bay Area, he has written for San Francisco Magazine, California Magazine, the San Francisco Chronicle, and Priceonomics. He has worked as a summer associate at the Congressional Budget Office and has a master's in public policy from UC Berkeley. Amy Bach has been a professional insurance consumer advocate since 1985 and an attorney since 1989. She co-founded United Policyholders in 1991 and serves as the organization's executive director and primary spokesperson. A nationally recognized advocate for policyholders and an expert on insurance trends, claims, coverage, law, and public policy, Bach is in her second term as an appointed member of the Federal Advisory Committee on Insurance and has been an official consumer representative with the NAIC since 2009. Our last panelist is Vanessa Wells, who is an attorney and partner with Hogan Lovells US LLP in their Silicon Valley office. Her experience spans civil actions, implicating insurance pricing or business operations issues, rate negotiations, market conduct exams, constitutional regulatory challenges, rulemaking proceedings, and public policy advice and negotiations. She works with regulators and industry participants to help them understand the interests of all concerned. As you may know, California Insurance Commissioner Ricardo Lara recently announced several reforms. Since he's written on the topic, I've asked Ben to begin by discussing what he's seen as what he's hearing in Sacramento. Ben?
Great. Thank you, David. Appreciate you inviting me to this, and hello to everyone. Thanks for spending the afternoon watching. So as David mentioned, I'm a housing reporter with Cal Matters, which is a nonprofit news outlet that covers California policy issues and politics. And increasingly, particularly this year, being a housing reporter has also meant being a part-time home insurance reporter in California. So I think my role in this discussion is just going to be to sort of explain how we got to this point, maybe provide sort of a big picture before we sort of get into the weeds. I'm guessing a lot of people on this who are watching might already have a sort of a baseline familiarity with the problems facing the state's home insurance market. But for those of you who aren't, I think it might just be a good idea for sort of for me to set the scene, as it were. So I hope this won't be too redundant for anyone. But I think you can't really understand the dysfunction of the home insurance market and the problems that many homeowners are facing in sort of getting affordable insurance without understanding California's ongoing wildfire problems. So just to sort of put numbers to this, the statistic kind of always jumps out at me, which is that of the top 20 most destructive wildfires in California history in terms of property destruction, of the top 20, 13 have occurred since just 2017. So there are a number of reasons for that: climate change, forest land management issues, development patterns that have sort of pushed a lot of growth into sort of these more wildfire prone areas. But regardless, I think the overarching point that is maybe worth dwelling on for a second is that there's a large debate about sort of the policy minutia here, about sort of the proper role of regulation and sort of what the structure of the insurance industry. But I think big picture, the risk to life and property in California from wildfire has increased as it has across a lot of the states that people are calling in from. So a lot of this is sort of fundamentally, I think, a debate over who should have to foot the bill for that higher risk. Is it going to be the insurance companies? Is it going to be homeowners who are sort of left paying higher rates, or not able to afford it all, living in some of these areas? Is it going to be the state taxpayer who comes in and foots the bill? So on the one hand, you have this sort of rising risk that has been really escalating in the last few years. On the regulatory side, you have a system in California in place, basically in place since 1988, in which insurance companies have to submit proposed rate increases to the Department of Insurance. They have to justify those rate increases by pointing to sort of specific criteria or specific reasons. Those rate increase proposals can be challenged if the rate increase is over a particular threshold. If it's over 7%, it triggers a public hearing process. So I think from the insurance industry perspective, and you've heard this this complaint or these series of complaints sort of growing louder and louder over the last few years, the cost of doing business in California is rising as these risks increase from wildfire specifically, but also just generally higher construction costs, meaning it's harder to rebuild after a fire, for example. Also, the cost of reinsurance has increased overall, reinsurance. So you have this higher risk, these higher costs, and then you have a state regulatory system that makes it what the insurance companies argue arduous, difficult, slow to sort of appropriately price that risk. So I think that's sort of the debate that you've heard from that side. Things I think really came to a head as the state really started to claw its way out of the pandemic. During the pandemic, there was kind of a broad freeze on rate increases. Coming out of it, you had insurance companies saying, look, we gotta get higher rates now, or we can't do business in California. And so you start to see this sort of, I've heard it described by some consumer advocates as a sort of a strike or sort of a slow motion exodus or a slow motion retrenchment from California from the industry. So the number of non-renewal notices that insurers are sending to homeowners really started to shoot up. The number between 2017 and 2021, it increased by 45%. At the same time, the number of people on the FAIR plan, which just came up in the prior discussion, which is the sort of the state chartered fire insurance policy of last resort, that almost doubles over the same period. In fact, I was just checking the news before this to make sure I wasn't forgetting anything. And I saw an article from the San Francisco Standard, which I think Amy is quoted in it, so maybe she could talk about that. But San Francisco Standard today saying that the FAIR plan is now getting something like 1,000 applications a day. And then in 2022, 2023, things really come to a head where insurance companies start to announce that they won't be doing new business in certain parts of the state or across the entire state. And the big one came in May of this year, which was State Farm, which is by far the largest insurer in the state with about 20% of the market. And they announced that they would not be issuing new policies anywhere in California, not just the high fire risk areas, but downtown LA. I live in Oakland by the water. There's not much of a fire risk here, but not issuing new policies here. And I think that more than anything really elevated this issue from more sort of a wonky regional concern to a statewide political concern or even a crisis. So state legislators began trying to hash out a solution in the immediate aftermath of that. And basically what they're hearing from insurers is that there's sort of a series of demands. It's not just that they want to raise the rates in general, but they want a faster rate approval process. They want to be able to factor certain things into the rate applications that they get. So specifically the cost of reinsurance. Insurance companies also want to be able to use statistical models to make predictions about how severe the risk is in a particular area, or a particular parcel, and to price their policies accordingly. And long story short, the legislature doesn't get there, isn't able to come up with a deal. I don't think in retrospect it's super surprising, just because I think it's fair to say it's not necessarily a political winner heading into an election year for a lawmaker to vote to allow insurance companies to charge homeowners more. And so the legislature ends its session in September. All eyes kind of turn to the state insurance commissioner, Ricardo Lara, and that brings us to last month when Lara made this announcement that David just mentioned in this kind of proposed regulatory reform package or an overhaul or however you want to call it. And you can kind of think of it in the way that I kind of thought about it and wrote about it when I wrote about it last month. It was this kind of bargain that Lara was proposing to the industry. So on the one hand, insurers do get a lot of what they've been asking for. They get to factor in reinsurance costs to a certain extent. They get to use these forward-looking statistical models that I mentioned. In exchange for those sort of benefits, those goodies, companies will have to provide a certain amount of coverage in areas that are designated to be high fire risk. So they won't be allowed to just sort of cherry pick the sort of safe parts of the state, like only picking downtown LA or whatever. They have to provide a certain level of coverage, and specifically, they have to provide coverage in those high risk areas equivalent to 85% of their statewide market share, which is kind of a mouthful and hard to say clearly. But basically, like if a company has, for example, 10% of the statewide market in California, they have to provide 8.5% of the policies in rural San Bernardino County or Placerville or whatever the high risk area is we're talking about. So that's sort of the trade that Ricardo Lara has proposed here. I think there's still a lot of open questions about how that's going to work in practice. So a couple that come to mind for me about these statistical models, which ones are going to be used? Will there be will the public be able to look into those models, look under the hood, make sure that they're fair, examine the inputs and the assumptions that are cooked into them? You talked about the cost of reinsurance, but Laura has said that they're only going to be able to include the cost of reinsurance that is attributable to California. I have a hard time understanding how anyone could figure that out, but I don't have a degree in statistics, so maybe someone smarter than me can figure that out. Then there's the 85% rule. Does that apply to all insurers, or what about insurers that are only regionally concentrated? So there are a lot of kind of questions about how this would work. And then there's the question of timeline, which is, this could take a while. The department has to promulgate the rules, and there's going to be public comment, and there's going to be a response to the public comment, and there might be a lawsuit thrown in there. Who knows? So this could take a very long time. And in the meantime, the question that I have is, what does that mean for the market? What does this mean for desperate homeowners? What does it mean for the FAIR plan, which we mentioned? And so that's what I'll be keeping my eye on as a reporter and just as a concerned Californian for the coming months. And with that, I think I'll probably shut up and just pass it on to the next person.
Yeah, so thank you for that. That sets the table for our discussion going forward. I'll now pass it to Amy Bach, who is a consumer advocate with United Policyholders. And Amy, you've got a pretty good view of the issues and the policy options. What's on your mind?
Thank you, David, and thank you, Ben. And it's kind of full circle to be here with Vanessa Wells, because I cut my teeth right out of I was just not that long out of law school when I was working for what then was called the Prop 103 Enforcement Project. I as their representative in the hearings that were convened in an old former abandoned school in San Bruno, California. And we had this big room full of lots and lots of lawyers for the insurers. Vanessa was one of them. And then there was me for Harvey Rosenfield and the Prop 103 folks, and then the DOI folks. And so, here we are, fast forward. It's been many, many moons since I was representing Consumer Watchdog, or really, we're consumer advocates. But my organization that I co-founded in 1991 has had a very, very different focus from Consumer Watchdog or even from Consumer Fed, in terms of they have always been very focused on the rates and the pricing. And my organization has been very focused on the quality of the insurance products, helping people make good decisions about buying adequate coverage, and then helping people use their insurance when they've had a loss and they need to navigate the claim process. So for many years, I would sort of say, well, the prior approval process is a whole ecosystem unto itself. I'm not really involved in it much at all, much more focused on like I said, the quality, right? But there have been a couple times where my organization got brought in when availability got funky. There was limited availability of home insurance, and so we started to get a lot of insights about what makes insurance companies decide to non-renew, where, when, how, why, and then what consumers can do when they get non-renewed and they need to replace that coverage. And so I think right after we were formed, right around the time of the Oakland fire, there was a period where a lot of the people who lost their homes in the fire had got non-renewal notices. And they came to our organization because we were now very prominently their friend and helping them. So a lot of people came to us and said, hey, I just got a non-renewal notice from State Farm or Farmers. I don't know what to do. And a lot of these people, were insured with a captive, through a captive agent that only wrote for one company. And so we were able to do a program with the city of Oakland called Match Up, where we basically explained to consumers that there's such a thing as an independent agent, and they have relationships with lots of different insurers. So if your State Farm agent can't get authorization to offer you a replacement policy, then you might be better off with a broker, with an independent agent. So we were able to cure that little episode of availability problems very quickly, and with a very simple matchmaking program with the independent agents and brokers and the city of Oakland. So, but it was interesting to me at the time, is I thought, well, where's the logic there that this area has been hit by a wildfire? So a lot of stuff is burned. Why drop people now? Why now, right? But I came to understand that it was the red ink that caught the exec C-suite attention, big homes, big payouts, not appealing, right? So fast forward to 2016, when tree mortality crisis, 120 million dead trees along the spine of the Sierras. I get a call from a local lawmaker in the foothills I had been brought into this tree mortality task force insurance subgroup that the governor created to say, wow, insurance companies are noticing this climate change thing. They're noticing all these dead trees. They're noticing this tinderbox situation, and they're non-renewing people in the foothills, in the areas, and elected officials are starting to need help. And my organization started to try to think about what we could do to help. And so we launched an initiative. And just to jump forward to where we are today, I think everybody who's in the insurance business in California knows that in a lot of zip codes in California, we're in the grip of a very serious, unprecedented availability and affordability crisis, where really competition has ground to a screeching halt in a lot of these areas. Now, you might say, you might take issue with my mention of the word screeching halt, because I think, for those of us who are in the business, this situation has been developing for it's been developing at least since 2016. You could argue from the time that the NEIC launched the climate change risk disclosure survey and said, we want to make sure that insurance companies are paying attention to climate change. You could argue that from the time that insurers, one of the first economic powerhouses to say climate change is real, it's here, and start adapting their operations in anticipation of it. You could argue it's been going on since at least 2007 or so. But where it really started to get more and more acute was starting in 2016 with the tree mortality crisis. So fast forward from there, my organization, our partners, CAL FIRE, the Department of Insurance, agents throughout the state are now our partners. Fire safe councils, firewise communities, mitigation specialists, local governments. We are all really have been working together to try to solve this crisis really since 2016. And it kind of, obviously 2017, when we started, when we had Tubbs, Atlas, and then we had Woolsey, and then we had Thomas, and we had Glass and Walbridge, and all these fires that Ben mentioned, it just kept getting worse, right? To the point where, my organization, because we're very pragmatic, we have been offering these shopping help webinars for consumers, free online webinars. I use independent agents typically. Sometimes, actually, I do have often now, I have a farmer's agent. Farmers agents have been allowed to get appointments with surplus lines carriers, so they have a little bit more options to offer than typically than than a State Farm agent does. So I've had these panels and we've been doing these workshops. I think I've done I've done a lot of them. And while we've been offering these shopping help webinars to tell people, okay, what do you do in the here and now? We have been engaged in higher level policy conversations with, obviously, we work very closely with the commissioner. We worked with Assemblymember Wood and Assemblymember McGuire, and we learned what sort of the dynamics that are in place here. It turns out that this is one of those examples where when the free market, when competition works, it's great for consumers, right? But when competition doesn't work, then public officials have to scramble a little bit. And that's where we're a little bit scrambling, right? No one is happy to hear what's going on with the FAIR Plan. No, consumers don't want to be in the FAIR Plan. The admitted carriers that have to participate in the FAIR Plan don't like it. They hold their nose and do that business. Public officials are nervous about it. And we all know that we are at a very critical point right now with our marketplace in California and around the country, because we have insurers reacting to climate change. We have the advent of predictive analytics, the catastrophe models that Ben mentioned that are forward-looking. That's what makes them different from how we've been rate making in the past based on historical data on what we know has happened. CAT models extrapolate and project what could happen, which makes them vulnerable to assumptions. And so a lot of concerns there. And we have the advent of risk scoring, which has had a tremendous impact on the competitive market and consumers. And then we have inflation, and then we have drone imagery. So risk has become so much more vivid to insurers that we understand why they're acting the way they're acting. We understand a lot of why underwriters have pulled back, why insurers are pulling back, why reinsurers not only have, obviously, I think everybody is pretty sophisticated in your audience. So, we have had a hard reinsurance market. That happens. It's predicted to ease up a little, but clearly the availability crisis that we have today in so many zip codes, not just WUI areas, wildland urban interface, but also in suburban areas, is a combination of forces. You can't say there's one thing to blame. And while, of course, these days, Americans are always looking to blame somebody. Oh, it's Commissioner Lara, it's Prop 103. I think all of us who are here today are sophisticated enough to know that there's not one thing to blame for the situation, and there's not one magic wand. So where are we, right? My organization continues to try to help people navigate this very difficult marketplace. If you have no choice, if you can't get an admitted company, can you get a non-admitted? If you can't get and if you get a non-admitted, make sure you check their fiscal strength because they're not protected by the guarantee fund. If you have no choice but the FAIR Plan, these are your options within the FAIR Plan for some add-on extra coverages to try to bring it up. And then what's a DIC and how much does it cost? So we're doing that hands-on consumer education. It keeps getting harder, right? We were putting a lot of emphasis on mitigation, and we still are. Part of our sort of arms locked with CAL FIRE and all these people who are trying to problem solve here has been, okay, let's incentivize. Insurers say the risk is higher. What can we do to reduce it? Okay, we can throw more money at mitigation. We can throw technical resources at mitigation. That is happening. Money is flowing from the federal government. Money is flowing from the state government. Lots more grants available. Lots more programs. Lots more funding for prevention, fire agencies, clearing shaded fuel breaks, and all that sort of thing, doing inspections, having trained mitigation specialists to go out and tell people, do this, this, and this. Insurers are going to be slow to get on the bandwagon here. They're going to say, we want to see a lot more data that shows the efficacy of mitigation before we reduce our rates, but we can't wait, right? So Commissioner Lara has put into place the mitigation discount regs. We only have one discount approved so far from the filings from last spring. And just to fast forward and pave the way for Vanessa, I'm going to wrap up by saying that clearly with these two wish list items that insurers have been on about for now quite some time, they want to be able to pass along their reinsurance costs like they can in other states. They want to be able to use CAT models like they can in other states. I think it was on the wall, the writing was on the wall that the commissioner was going to need to give them something. And I think what he's tried to do is get something in return. And as Ben said, and as I've been saying, there are many regulatory rivers to cross before we see how this deal plays out, right? 85% is supposedly the deal is we're going to have higher FAIR Plan limits, which would so that maybe, but the FAIR Plan hasn't agreed to that yet. They've agreed to 20 million per location, not per building. So we'll see how that plays out. That's a whole nother area of crisis. We will see how this give back, this concession that the commissioner negotiated, I hope, it sounds like he did, but the carriers have been a little unclear about whether they're on board with saying, if we get the ability to use CAT models and the ability to pass along some portion, let's say if we can break out our California reinsurance, some portion, then we will agree to write in these WUI areas something around 85% of our market share. It's still a little confusing to a lot of us. I have a lot of confidence that Ricardo Lara did the best he could in the negotiations, but we don't have a lot of leverage here. The insurers are holding the cards, right? We really don't, we have to build a plan B. And that's kind of where we are. And yeah, a lot of eyes are on, is it our rate reg system? And I've said this to insurers, you're afraid of consumer watchdog? Come on. The commissioner has been saying, I've told them to come in for their full rate. If they don't want to go to hearing, that's their business decision. So just, I want to throw it to Vanessa. Listen, I was quoted in the press release that the commissioner put out about the sustainable strategy saying, let's see some progress. I got a nasty gram from Harvey saying, shame on you. So I have put myself at odds with my consumer advocate colleagues because I am trying to help solve this problem. And I don't think that Prop 103 is the problem. I think we have much bigger problems here. And that's basically my view. So thank you again for having me on the panel.
Sure, Amy, thank you for your comments. And there's a lot to unpack there. And Vanessa will be batting cleanup and we'll follow with some Q&A at the end. It's a very complicated problem. And we're talking about hundreds of billions of dollars of total insured value. And early in today's presentations, we saw that the pace of climate change may be accelerating. And so the risk may be accelerating. So how we can incentivize insurers or some sort of pooling mechanism to come in and take that risk is kind of front and center. So Vanessa, you've spoken, you've been in these negotiations or advocacy, you've been involved in this for some time now. I'm sure you have an educated opinion.
Oh, thank you, David. I would say actually this has been my life for some time. So going back to some of those early proceedings that Amy was talking about in her presentation. So I think, and what I do is I represent insurance companies. So I'm taking the side of the insurance perspective. I represent State Farm, Farmers, USAA. I represent a lot of small companies as well. So just to be clear what my perspective is, that's what I represent and that's what I have seen the most of. But I want to start by saying that I think that this is a problem that's real and it really does exist and it doesn't benefit from politicking. In order to resolve this, people are going to have different viewpoints and that's fine. But you can't add extra problems by saying, well, really, there's not really an issue in California, except that the insurance companies want to create it so they can make more money. So that's just not helpful. We have to deal with the underlying issues that are causing this risk to become so great. To add to some of the history that Ben and Amy both talked about, I would say that a relatively short time ago, we in California really did not realize the extent of the wildfire risk to residential property in California. I remember back at the time, right after the 2017 fires. Now, these were very bad fires. The Senate held a committee hearing, insurance committee meeting, to talk about the problem. And there were a lot of experts appearing at that meeting, basically saying, nothing to see here. I remember one expert talking about the amount of money that there is in the world, and it's looking for a home. So we're going to get reinsurance. It's not going to be an issue. So I would say when things really changed was after the Camp and Woolsey fires in 2018, because then it no longer looked like a one-off in 2017 that we had that cluster of fires. Meanwhile, our fire professionals were telling us from all of that experience that these fires are not behaving like wildfires we've dealt with in the past. So that is a result of climate change, and it is making it more difficult to figure out how to fight wildfires. Prior to these fires in 2017 and 2018, there were some that thought that we could never see a conflagration like we did in 1991 in the Oakland Hills again. Well, no one thinks that anymore. It's been outpaced by a great deal. So this is a real issue that has to be addressed. And I will take just a short moment to talk about how catastrophes are included within rates. I hope it's not too horribly boring. I know that the people here are all insurance professionals, but they don't necessarily focus on minutia like the rates. So we look at insurance losses and insurance expenses to project forward to what rate should be going forward. And we're talking about personal lines insurance, which is a different exercise than big commercial risks. So, but in projecting losses, what we do is we take out the catastrophes because they are uneven in their presentation. And if you just left them in with the non-cat losses, you'd be in some years projecting a ridiculously high risk going forward, and in other years it would be ridiculously low. So you take all the catastrophe experience out, and you're going to substitute for that catastrophe experience a catastrophe factor. So other than for earthquake risk, because in California we do use these complex models that include science and statistics for earthquake and for fire following earthquake. So what we have done in every other area is that we use the historical experience. And as I think has been emphasized throughout this day, the historical experience just isn't telling us what's likely to happen in the future because there's been a big change. I'm sorry, I forget which presenter it was, but it was in the very first panel today, talking about how and there was a graphic showing what Miami looks like now compared to earlier on. So you see just a lot more expensive buildup of risks along those along the risky areas within California. And in terms of high fire areas, well, of course, remember what we saw in 2017. Nobody really thought that Santa Rosa was a high fire risk area, but we had those terrible fires that included that. So the reason why the industry wants to be looking at using these models is to take those to either substitute or constitute part of what you're using to create the catastrophe factor within the rates. And that, as I noted, that is what we do already with earthquake. So from the insurance perspective, I guess I could say from our perspective, that's going to give a much more realistic picture of what the risk is in the state, so that that risk can be priced appropriately for the insurance. So in connection with this, I just also want to mention a piece that as insurers, we would think of as being the regulatory risk. So part of Proposition 103, as has been mentioned, is that if that you get to have interveners, okay? So any person can come in and say, I'm an intervener in a rate hearing. If the rate increase for personal lines is requested is more than 7%, that intervener can ask for a mandatory hearing. So what you need to understand about what a hearing is that it takes years. It takes a lot of money. Let's see, the most recent one was the State Farm hearing on a December 2014 rate application. That hearing ended with a decision in November 2016. State Farm sought review of that decision, and the ultimate result in the Court of Appeal ended in February of 2022. That's when the California Supreme Court denied review of the October 2021 decision by the Court of Appeal. So, as Amy was pointing out, this is not an issue that we can take that long to resolve. It's something we have to be able to react to in a more timely way. So when we talk about insurers are afraid of hearings, it's not that they're afraid of consumer watchdog. It's not that they're afraid of having their rates examined. It's the time and the money that goes into that process rather than getting the rate, which is what, from the insurance perspective, that's what they need to continue in business. They need that rate. Just a further look at what we've seen historically. As I noted, there wasn't a lot of big worry about fires until 2018, but even before 2018, you started seeing non-renewals. So, the pace of that accelerated in 2018. So we already had this crisis building before you saw then some of the big insurers. So all of these policies are being non-renewed. Where does that business go? Well, it's flowing to companies that are still taking new business. So then you see, then you start to see those companies that are still taking new business saying, I have to cut off taking new business so I can serve my policyholders I already have. So that's why in this new phase, you're seeing cutting off new business instead of non-renewing. There's several companies that didn't non-renew. They've stopped doing new business in high fire areas, but they didn't non-renew. And so now they got this additional book, because where was that business going to go? Nobody really wants Fair Plan or the non-admitted market. So then there was a crisis. So then there's a crisis for new business insurance. And that's when people sat up and took notice of it. So I think that there's a lot of factors that are going into where we are now. It's helpful to look at where these things came from so we can figure out how to fix it. It's not helpful to play the blame game and say, oh, it's your fault. Let me go back and talk about that regulatory risk, because regulatory risk can exist without the regulator actually, putting the thumb down on the scales in any way that's unfair. Regulatory risk existed here because everybody filed for 6.9 so as not to get into a situation where they could be held to a mandatory hearing. So with all of those 6.9, 6.9, 6.9, you're leaving needed rate on the table every single time that you're making a filing. And that contributed to the underfunded situation that we have in California now. So the two places that we're looking for to cover cat risk are going to be the surplus of the company and then the reinsurance the company is able to get. As we've heard already today, the reinsurance market has hardened. When you can get reinsurance, it's high priced. Surplus has taken several hits with the various catastrophes that we've had. So this year, okay, so far, no wildfires, but we had the winter storms. So there's just been big dipping into surplus as well as needing to get that reinsurance recognized in the rate. So one more point to hit on before we can, have more of a discussion if people want to, is that there's also a brewing crisis with auto. And that comes from more something that Ben was talking about in his introduction. So the department wasn't approving rate increases during the pandemic. That was for auto, not homeowners, but for auto. So we kind of built up a bit of a deficit for the auto industry. We then land in a situation where inflation just goes out of control. Very high inflation. Severity is the worst that it's been for a long time for private passenger auto. The thinking is that people learned how to drive badly during the pandemic because the roads were more empty, and then they just didn't change back to better driving habits when the roads became full again. That theory has been postulated in any event. So severity is way up with inflation and with this worse driving situation. And so the auto industry is in a situation where they also need double-digit rate increases, which similarly to the homeowners market, everybody has just been asking for 6.9, 6.9. And until we're in this situation where you really need to get that double-digit rate increase, and you need it now. So those are the issues from the insurance side. So not wanting to leave everybody in a situation where it looks like doom and gloom. We do try to think about what can happen that would make things better. I know that the insurance commissioner is working very hard to try to create a regulatory environment that is looks more at current circumstances, the things that we're facing today, which is different from where we've been prior to the pandemic, prior to the increase in wildfires that we're seeing as a result of climate change. So the commissioner is trying to make things easier. I'm not sure how much we need the legislature to make those changes. I think that there's room within Prop 103 to work with, but Proposition 103 is the initiative that passed that gave us our insurance regulatory laws in California, rate regulatory laws in California. So there's room to work within that matrix that the law gives us. I think the legislature could help in perhaps some other ways. There are other types of policies that perhaps could be offered that would help consumers select how much insurance that they can afford to pay. Loosely speaking, we've referred to things like parametric policies, where if you have the catastrophe, you have the event, you have the mapping, where it's easy to see that the particular home was hit by the event. Perhaps you could have a policy where you don't have to list out every pair of jeans that you lost in the fire. You can just collect the amount that you've paid for under that policy. So there are possibilities, and we need the legislature's help for some of that. I did want to mention one thing in response to a question that was, I think, David, you made it to Glenn Pomeroy. asking if we thought about having something like the CEA for wildfire. That becomes very difficult. Every insurer has a different way of classifying what constitutes a wildfire catastrophe for that insurer. So it's not all the same thing. You would have to try to figure out where you're going to put in those measurements for what would be covered. Plus, you have to consider that fire is a really big part of the policy. Mm-hmm. With the FAIR plan covers all fire. So you don't have to establish a catastrophe. It covers all fire, and then the difference in conditions policy that Amy was talking about covers everything but fire. So that's something that would be very difficult without completely unwinding the way that policies are required to be in the state of California to come up with a solution that's similar to the FAIR plan.
Sure.
I was just looking to see if there was something we needed to answer. Somebody mentioned the rains. Yes, it is kind of cyclic how we get the different types of catastrophes. David, I'll yield to you.
Sure. We only have a few minutes left. Ben, what's coming next? I think we're in this sort of regulatory pause. There's been this announcement, and now there's actually the execution of the reforms and actually granting those rate increases and implementing all of this. Mm-hmm. Are you hearing anything at all in the halls of the State House or anything else?
I hate to disappoint, but I have not heard a whole lot, which isn't to say that there aren't those discussions happening, but they have. No one's been kind enough to share them with me yet. But no, I mean, from what I've heard, having spoken to a handful of people about this, people are still digesting the proposal, trying to figure out sort of what it would actually mean in the legislature. I mean, to Vanessa's point, I think there was an initial sort of quiet applause among the legislature to Laura for putting forward this proposal. There were some, in the press releases, some key members were saying, well, I look forward to picking this up when the legislature returns in December. I wouldn't be surprised if there was also some relief among legislators that Laura sort of saved them from having to take what would be kind of a tough vote. So we'll see what they actually do and whether they sort of take any of the issues that Vanessa mentioned up in the coming session.
Right. So Amy, will kind of give you the last word.
Thank you. Great discussion. I think obviously it should go without saying that people are already paying, in these areas where they've had to either go with a non-admitted or go with the FAIR plan. It's just they're getting crushed, right? But just in terms of trying to pay for their basic insurance. So we do have a pretty serious situation on our hands, because if the insurers are saying they're not getting to charge what they need to charge, but people are already paying so much more than they had been, we know we have a really big problem on our hands, right? So I would just say, years ago, my organization, before Lara became commissioner, he was still in the Senate, we brought him a bill that was based on law in Pennsylvania that basically has the same short list of reasons that insurance companies can cancel mid-policy apply to a non-renewal in Pennsylvania. They can only you can only non-renew for the same reasons you could cancel. Non-payment, discussion, you're having, find out they're cooking meth, whatever. We brought that to Lara. He said, sure, I'll carry it. Let's see if that will help. This was in the very early, before he, when this was starting to develop. That bill hit 3 days in, the committee staff said, Amy, this thing's not going anywhere. Okay, I get it. So now, fast forward, Senator McGuire has brought a bill that's, I think it's 624, that says that if the homeowner has met the Safer from Wildfire standards, the insurer must offer them a renewal or a new. Well, that bill hasn't even gotten a hearing. So I think that I think the legislature is probably going to stay back and let this deal play out and let the regulatory environment try to heal this schism, this crisis. But every time I think some competitor is going to step up and say, okay, CSC is leaving, we'll take their business, the way it's always been that, competition would come in to fill, it's all been bad news. Like, so we've heard a little bit of buzz that some on more entrepreneurial minded insurance executives are seeing opportunities in the market. I've got my fingers crossed for that, because our people are hurting badly. And obviously it's not just the consumers with their premiums, it's the small businesses, it's the real estate transactions, property, that tax base. It's a really big deal we've got on our hands. So I'm really hoping that the insurance execs are gonna just like you don't want, consumer advocates playing politics. We really need insurance executives not to play politics either, because it's not just about their ecosystem and their profitability. It's about this whole ecosystem that is integrally all tied together, mortgage, and the health of our local economies and our state. So I think we all know the stakes are high here. And we all, I hope, can approach this with sort of a, let's roll our sleeves up and come up with some concepts, because climate change is here, but we just had like 4 years without a big conflagration, right? So let's keep everything in perspective here and not go overboard in either direction.
Well, we're out of time. It's certainly hard to tackle something this large in less than an hour, but I'm grateful. Vanessa, Amy, Ben, thanks for bringing your expertise to our group, and hopefully we see healing and progress in the coming months. Thanks, everyone. I will hand it over to Alexis.